I think most investors are looking at this all wrong. They see a stock down 83% from its highs and they assume the business must be broken. They see the entire software sector get dragged behind a truck and they assume the truck knows where it is going. They hear two letters, AI, and suddenly they start talking as if 20 years of enterprise software infrastructure is about to be replaced by a chatbot with a clean interface and good branding. That is not analysis. That is panic wearing a suit. And panic has a way of making intelligent people say childish things. It makes them confuse a threat with an obituary. It makes them price temporary fear like permanent extinction. It makes them look at a real business with real customers, real contracts, real margins, real expansion, and real cash, and value it as if the company already died and the funeral simply has not been scheduled yet. That is where we are right now in software. The whole sector has been hit like the market discovered gravity for the first time. Names that used to be treated like growth royalty have been cut in half, cut by 2/3, cut by 80%, as if the entire software economy woke up one morning and found out electricity had been outlawed. People think this is about one company. It is not. This is about a sector-wide fear event, and those events are usually where the real money is made because fear never throws out the bad names only. Fear throws out everything it can reach. That is the opportunity. Not because every software company is good, most are not. Not because every beaten down chart is a gift, most are not. But because once the market starts pricing an entire district of businesses as if the fire has already spread to every building. The rare investor who can still walk block by block and check which buildings are actually made of steel has an enormous advantage over the crowd. That is the setup I think we have here. And the building I want to talk about is monday.com. But before I get there, I want to explain the fire, because if you do not understand why the crowd is running, you will not understand why I think this setup could change lives. The software sector did not collapse because all these companies suddenly stopped selling software. It collapsed because Wall Street got scared of what AI agents might eventually do to the seat-based SaaS model. That fear has a name now. Anthropic put out an agent platform. Other labs put out agent tools. Suddenly, the market started imagining a future where software is no longer sold to teams of people logging in and clicking through workflows. Instead, one AI layer sits on top of the business and does the work automatically. Fewer humans, fewer seats, fewer licenses, lower pricing power, lower revenue, lower multiples, sell everything. That is the cartoon version of the thesis. And like most cartoons, it uses the outline of something true and then distorts it until it becomes ridiculous. Is AI a real threat to some parts of software? Yes, absolutely. Any honest person has to say yes. The old model of charging more and more money for more and more seats forever with no disruption risk is dead. That fantasy is over. The industry will change, pricing models will change, product expectations will change, what customers tolerate will change. But that is not the same thing as saying the whole sector is going to zero. Those are two completely different statements, and the market, in its usual elegant way, has decided to price them as if they were the same thing. That is what creates the opportunity. People think software is just the interface. They think the app is the business. They think if AI can build a rough version of a dashboard, then the moat is gone. That is amateur thinking. Building the visible layer of software is the easy part. That is what nobody wants to admit. You can build a flashy front end, you can build a demo, you can build a prototype, you can build the part that makes people on social media say, wow, look what AI can do in 6 hours. That is not the hard part. The hard part is the plumbing. I want you to keep that word in your head, plumbing, because this entire story comes down to one thing. Wall Street saw AI build a prettier faucet and decided the pipes under every office building in America were worthless. That is insanity. The visible part of enterprise software is not what makes it durable. What makes it durable is what sits underneath the integrations, the permissions, the security audits, the compliance layers, the reporting systems, the workflows nobody even remembers setting up anymore because they have been running quietly for 6 years. The edge cases, the customer support, the implementation teams, the legal reviews, the procurement approvals, the internal habits, the data migration pain, the training, the change resistance, the fact that a Fortune 500 company does not replace the software that runs its sales team, project management, developers, it requests and cross-functional coordination the same way a college student swaps one productivity app for another. That is the plumbing. AI can help build software, it can help automate software, it can help replace weak software. What it does not do overnight is rip out enterprise plumbing with zero friction and zero cost and zero organizational pain. That is the first mechanism. I would call it the plumbing moat. And if you do not understand the plumbing moat, you are going to keep valuing enterprise software like a child prices a building by looking only at the lobby. Now let us get more specific. Monday.com is not just some task app with bright colors and a good marketing team. The market keeps acting as if it is an overvalued board with sticky notes. That is lazy. What Monday built is a work operating system. That phrase matters. A work operating system is not one narrow tool. It is a flexible environment that lets teams plan, track, manage, coordinate, and build internal processes in one place. That is why it spread beyond project management. That is why it moved into CRM. That is why it moved into developer workflows. That is why it moved into its service. That is why enterprise accounts keep getting larger. Once a company starts layering more and more internal functions on one platform, the platform stops being a nice-to-have dashboard and starts becoming part of the operating fabric of the business. That is when switching gets expensive. Not expensive in headline price, expensive in friction. That is a more dangerous cost. A lot of investors only look at the sticker price of software. They forget the replacement cost. The replacement cost is not what you pay the next vendor. The replacement cost is all the disruption required to leave, all the retraining, all the migration, all the broken workflows, all the internal people who now have to stop doing their actual job so they can participate in a software transplant. That cost is enormous. That is why a lot of software does not get replaced when a better idea shows up. It gets layered onto, it gets integrated, it gets copied, it gets slowly adapted. That is what real-world adoption looks like. And that is why Monday is more resilient than the chart suggests. Now let us get to the second mechanism. I call it the seat collapse myth. The market is acting like AI means companies will suddenly need far fewer seats and far fewer licenses. So every SaaS company has a dead business model walking around in a nice shirt. Maybe eventually in some products it becomes partly true. But the market is behaving as if it is already true everywhere. Right now, that is not what the numbers say. The numbers say customers are still there. The numbers say renewals are still happening. The numbers say gross retention across the sector is still around 90%. That is not collapse. That is not customer flight. That is not the behavior of an industry getting replaced this quarter. That is the behavior of customers who still need the software while the market is busy writing a science fiction. Obituary, the difference between narrative and numbers, is where money gets made. Retail investors keep falling in love with narrative. They should fall in love with retention. Retention is one of the most useful truths in all of software. You can fake growth for a while. You can market your way into attention. You can get a lucky cycle. You can surf hype. What you cannot fake for very long is customers continuing to pay, continuing to renew, continuing to expand usage, and continuing to build more of their own operation on top of your platform. That is not hype. That is habit turning into dependence. And Monday has exactly that. The company keeps adding subscriptions. The company keeps growing paid customers. The company keeps moving up market. The company keeps landing bigger enterprise contracts. And every one of those is more important than the stock chart. Because when sentiment finally flips, the businesses that come back hardest are rarely the businesses with the loudest communities or the cutest brand. They are the businesses with the strongest operating facts that got mispriced during the panic. That is where Monday sits. Now let us talk about the third mechanism, the margin machine. This is the part that makes me laugh when people talk about a company like Monday as if it is one bad quarter away from irrelevance. Monday keeps roughly 90 cents of every dollar of revenue after the direct cost of delivering the software. That is extraordinary. That is not 10 million commodity business. That is not some low-quality operation scraping for oxygen. That is a software machine with enormous room to invest, pivot, build, defend, acquire, and outlast weaker competitors. Margins like that matter even more during a sector panic because they give management choices. A low-margin business has to pray. A high-margin business gets to adapt. That is a huge distinction. Everyone keeps talking about AI as if only startups get to use it. That is silly. The companies best positioned to use AI are often the ones with distribution, installed customers, operating cash, deep integrations, and enough margin to fund the transition. Monday has all of that. So when the market prices Monday like AI is only a threat and not also a tool Monday can use to make the product stickier, more valuable, more automated, and more enterprise ready. That is not efficient pricing. That is one-dimensional thinking. This leads to the fourth mechanism, the reversal engine. Every real panic has one. A reversal engine is the thing the market thinks will kill a company, which later becomes the thing that helps the company. That is exactly what can happen here. Everyone is acting as if AI is coming for Monday from the outside. What if Monday absorbs it from the inside? What if the platform gets more valuable because companies can build agent-driven workflows on top of the system they already trust? What if the fear that customers will abandon the software turns into a reality where customers want deeper AI embedded into the software they already use, already integrated, already audited, already approved, already rolled out? That is not fantasy. That is one of the most likely outcomes. Monday is already leaning into this through agent tools and AI layers that matters, because the companies that survive platform shifts are not usually the ones who deny the shift. They are the ones who incorporate it fastest into an existing distribution advantage. The crowd always underestimates how powerful existing distribution is. A startup can have a beautiful product and still struggle because nobody trusts it. Nobody has budget approval for it. And nobody wants to retrain 3 departments for it. An installed platform with enterprise traction can ship a new feature and immediately put it in front of customers who are already paying attention. That is a monstrous advantage. That is why the incumbent is not automatically dead every time a new technology shows up. People have been burying enterprise software for years. Then the next cycle begins and the survivors come out stronger. That is the 5th mechanism, the history trap, and I call it a trap because the market keeps stepping in it. This is not the first time software has been repriced, like the business model was over. It happened before. Different trigger. Same psychology. In 2016, there was a SaaS panic that looked catastrophic in the moment. Stocks got crushed. People said the multiples would never recover. The story was that enterprise spending had changed, competition had changed, growth had changed, the game had changed forever. Then what happened? The survivors survived, the quality names recovered, the sector re-rated, and people who sold into the panic spent the next few years watching other people get rich from positions they once owned. That is how sector panics usually work. The crowd starts with a real concern. Then it prices the entire sector for death. Then time reveals that the strongest companies were not in a death spiral at all. They were just being sold by people who wanted one simple answer to a complicated transition. The market loves one simple answer. It is usually wrong. And that brings me back to Monday specifically. Why this one? Why not Oracle? Why not Salesforce? Why not a dozen others? Because Monday has a combination I find very hard to ignore: a platform model, strong retention, enterprise expansion, enormous gross margins, multiple product vectors, AI integration potential, and a chart that has been treated like a crime scene. That combination is rare. It is one thing to find a bad stock down 83%. The market is full of those. It is another thing to find a real business in a hated sector with real operating strength that got dragged down inside a sector liquidation so extreme that the stock stopped being priced for disappointment and started being priced for permanent failure. That is the sweet spot. That is where asymmetry lives. People misunderstand asymmetry all the time. They think asymmetry means moonshot. It does not. Asymmetry means the downside is being priced as if the business is in terminal decline, while the upside remains tied to outcomes that are still very plausible. Monday does not need perfection from here. That is the beauty of the setup. It does not need to become the only work OS in the world. It does not need to monopolize AI. It does not need to become Salesforce, Microsoft, and ServiceNow all at once. It just needs to remain a real, growing, profitable enterprise platform and prove that the apocalypse priced into the stock was ridiculous. That alone can re-rate the multiple. And when a multiple re-rates at the same time revenue keeps growing and margins stay elite and enterprise contracts keep expanding, the upside can get violent. That is what the crowd never appreciates. They think recoveries happen in gentle little moral lessons. They do not. When sentiment finally turns after a sector panic, it often moves with the same violence that the selling used. That is why I care so much about the setup. Now let me be disciplined here. Could I be wrong? Of course, a real thesis has to say that. Could AI compress software pricing faster than I expect? Yes. Could Monday stumble on execution? Yes. Could this sector stay hated longer than most people can tolerate? Absolutely. Could the market decide that even good software businesses deserve lower multiples than they had in the old era? Yes, and frankly, I think some deserve exactly that. But that still does not break the core argument. The core argument is not that Monday deserves its old high tomorrow. The core argument is that the market has dragged the stock to a place where it is no longer pricing adaptation. It is pricing disaster that is too extreme. And extremes are where long-term investors make their money. I want to say something else that a lot of people need to hear. A stock being down 83% does not make it cheap. A stock being up 500% does not make it expensive. Price alone tells you nothing. You have to ask what the business is, what the economics are, what the customers are doing, what the margins are, what the path is, what the mode is, and what the market is assuming from here. That is what separates investors from tourists. Tourists look at the chart. Investors look at the assumptions inside the chart. The market is assuming right now that software as a sector is impaired, that AI will weaken the seat model fast, that companies like Monday will struggle to defend value, and that the old playbook is finished. Fine, maybe parts of that are true. But the market is also ignoring the fact that Monday is already deeply embedded, already expanding, already profitable, already flexible, already multi-product, already enterprise credible, and already leaning into the very technology people say will kill it. That is not a zero. That is not even close to a zero. That is a real business getting priced like a broken narrative. And when the market confuses narrative damage for business damage, I get interested. That is the sixth mechanism, the narrative disconnect. This is one of the best places to invest, if you can stomach it. A narrative disconnect is when the stock gets treated according to the sector mood rather than the company facts. That happens all the time. Sometimes the sector is euphoric and garbage floats upward because the mood is generous. Sometimes the sector is hated and quality gets sold because the mood is disgusted. You make easy money in the first environment if you are lucky. You make serious money in the second environment if you are patient. Monday is living in the second environment. That is why this matters. Now let us zoom out one more time. What actually changes lives in markets? Not usually being early by 3 weeks. Not usually posting the hottest take. Not usually finding a cute small cap no one has heard of. What changes lives is catching a real business in a real mispricing large enough that when the market normalizes, the move is not incremental. It is re-rating plus growth plus sentiment reversal all happening in the same direction. That is where the huge outcomes come from. That is why I think people should take this setup seriously. Not because the stock has a cool story, because the ingredients are all here. Sector liquidation, oversold conditions, real customer retention, huge margins, enterprise traction, AI fear, AI optionality, muted guidance, analyst upside, still sitting there like a loaded spring, a platform that can keep expanding across functions. That is not a random collection of facts. That is the anatomy of a potential monster rebound. And if it happens, most people will not buy it before it starts. They never do. They will wait. They will say they need confirmation. Then the stock will bounce 20%, then 40%, then 60%. Then the same people who said it was dead will start calling it a comeback story, and they will buy what they were too scared to buy when the reward was the largest. That is how this works. That is why I say setups like this can change lives. Not because every buyer gets rich, because the few people who understand the difference between a broken stock and a broken business can sometimes catch a mispricing that pays for years. That is the whole game. Find the fear, check whether the business actually broke. If it did, walk away if it did not, and the market is still acting like a funeral director. Then you may have something worth owning while everyone else is busy running for the exits. That is Monday.com right now as I see it. Not guaranteed, not magical, not risk-free. Just one of those rare moments when a real company inside a hated sector gets marked down so hard by a future fear that the present facts stop mattering to the crowd. I love those moments because that is where markets stop rewarding consensus and start rewarding discipline. And discipline in the right setup is the closest thing ordinary investors ever get to unfair advantages.